But on the point of like there just will be demand, I don't have a strong stance on that, but I think the counter argument would be that crypto demand is very, very tailored towards like very explosive growth opportunities, and stocks just do not offer that. And we're back. As ill-prepared as ever, we're here.
And against the clock this time on top of that.
Even for us, I believe this isn't the greatest performance there is, but okay.
Exactly.
I gotta say, man, the Eraserhead hair is pretty impressive, Mika. And and if you haven't watched Eraserhead, well, maybe you shouldn't.
Okay. I didn't understand the reference well enough. But
I thought you meant like a literal eraser, like.
Okay, now we're not gonna get into a David Lynch topic right now. Let's keep on.
It is very David Lynch, actually. Mika, have you seen pictures of David Lynch? That's his hair.
No.
Well, Eraserhead was David Lynch's first movie, and it is the most David Lynchian of them all.
Anyway, so I've been running errands while you guys have been sweatily preparing the agenda for today's call. So I'll leave it up to you, but should we discuss this step finance thing quickly? Well, I guess like mainly kind of like tokenized stock in general, and then step finance being an example of that. There's a bunch of others as well, but I think that's definitely an interesting topic.
Yeah, maybe the way to start this is if I'll just ask the question on like how bullish are you on that market in a way, and what do you think it kind of takes for whoever's going to be successful at it to kind of really succeed at tokenized stocks?
Yeah, so I think maybe just to give like sort of like a baseline, I think tokenized stocks make a huge amount of sense. I don't remember if we've talked about this before, but if you look, so the argument that I kind of build up from is like if you look at any regional stock exchange, so basically like not, the NASDAQ in New York or whatever, like not the, what's it called? Is it called DAX in Germany? Like not the main lists. And you look at sort of the more regional ones. The one here is First North, which is like the NASDAQ kind of like small cap Nordic list and so on. And you look at those exchanges and you look at the volumes on these stocks. They are non-existent. Like to a crypto person, every single one of those is a failed project. Volumes are there's none. Part of this is something that I've discovered. Again, I don't want to generalize across the world because I don't. These are sort of pretty siloed, and other regions may operate differently. But what has been very surprising to me was discovering that basically they don't do market making. Like there's no concept of market making really happening, which even by itself already in my mind means that okay, volumes are going to be shit. But then just volumes are shit in general. Partly probably because the exchange is kind of like here, and all the brokers around the world are not connected to it because you need to be connected to so many. So you're mainly just connected to the big ones, like where most of the volumes are happening and so on. And so there's these like sort of structural problems in, I would say, like if we look at it from a amount perspective, I think like 80% of the stocks that are public are kind of like not served very well by the traditional system. If we look at about market cap, it's probably kind of like the other way around, but I do think these things are correlated. So if you're on a small list, it's fairly hard to like build up out of there because you just don't get that kind of volume. Just to give an illustration, like there was like one stock on First North, which had, I think it was like a daily volume of like a million. Like they're like really small. Like you can go check, this is public information. Anyone can go look at what they are in reality and can fact check me if I'm off the mark. But like order of magnitude here is correct. Like they're very, very small. And so the argument for tokenized stocks basically is just like maybe a lot of this is actually just an infrastructure problem. And if everyone is on the same rails, if you get access to all the like same market making services, like if all this tooling that we take kind of for granted in crypto was just available by default, then those markets would function a lot better. The problem always becomes jurisdictional differences in regulation around securities and how you can actually tokenize stocks without like, you know, having a kind of centralized exchange looking structure where like everything is KYC'd and like, you know, the same barriers that exist in the traditional markets. So yeah, I'm curious to hear how you guys think about it.
Yeah, I mean, I think you've covered most of it. I don't really think if we're talking actual companies, stocks, like existing companies, not just synthetics, I don't really think there's a good way around it without actually going the KYC route, etc. Precisely because of the legal issues. There's nothing new. I mean, FTX had acquired a license to do this in Germany from some German company that had it before. So it's something that had been done. As Tim was mentioned, I do think this is something that works much better for the long tail of stocks where there might not be as much inventory or as much market making and out there to be, you know, easily available across where you would want it. It is definitely one of those cases where I do think the long tail benefits in general, not but you know, the well-known names, etc. So given that, I'm not entirely sure how gigantic a business it would be, given that when you're doing market making, you're making pennies, right? Not even pennies, right? You're making like basis points for fixed and purposes on every trade. So unclear on that side.
We can take market making out of this because even the theoretical possibility that you can just like stick it on Uniswap and basically market make for yourself, that's like a big change.
Sure, but what I'm saying is if you have a platform if you have a drift, for instance, that is focused entirely on this, their fee is going to be 1 basis point effectively. So if this is a tiny stock if this is mostly geared towards savings, most stocks from tiny businesses that are not as well known and that do not move as much, then you're not going to be making as much money simply because there's not going to be as much volume or interest on these things, right? It's
who's not going to be making
the business that actually has to go through the KYC process, hosting the APIs, etc., and that gets maybe 1 basis point for every trade.
Yes, if that is how it works. So I think like I'm not sure exactly how to approach it, but like I think for everyone it would be better if that wasn't the way it worked.
I would agree, but I also do not see a way.
Very generalized KYC solution, which just like because the benefit of crypto is basically like access to a global market. If you fragment that into tons of tiny markets, the benefit kind of goes away, and so there's some balancing act. But there's also like there's like an interesting conversation to be had, which again, I'm not super bullish on this stuff because I don't think like the laws are going to change very quickly for these things. But sort of in an ideal world, there are probably arguments to be made where like if the token doesn't convey voting rights and has some like pretty reasonable structure for like dividend payments, like there's a couple of projects, I think they're out of Switzerland, which basically have this system where there's the token trades freely. But then if you want to get dividends or voting rights, you need to register that token, which is kind of like, it's a bit messy, but it does sort of achieve the right thing. Like it kind of makes the traditional financial ownership rights like an optional kind of thing, but then you use it freely because that opens up options for collateral. And that opens up, you know, different kinds of lending structures and so on. But as a question for that, Mika, I'm curious, like, I think the bigger question around all this is always like, is there demand for tokenized stocks within crypto? And that I'm not 100% sure about.
It's probably one of those things where you want to be just forward looking, and if you're going to take the thesis, you almost might, or take it, like make an investment in that area, you might almost make it with the idea that, okay, I'm just going to assume that finance is going to move on chain more and more. So like, is there a specific demand trigger right now? Maybe, maybe not. I don't really care about that. I just kind of take the long form thesis of, okay, this stuff is moving on chain, and it'll become increasingly kind of just used in various ways. Like if you look at the FTX tokenized stocks, I don't know what the volume on those was, but it was like a pretty good product, of course, until it all went down. Mirror was popular, and that one really was like a token incentives game. So pump a lot of token incentives into it, so the TVL grows. So that's a bit like artificial. But I guess you could make the argument that, okay, like Solana markets are just so much bigger right now than before. There's kind of more tooling around trading. So there's like a large enough initial market. The stocks themselves, if you pick like high profile stocks, they're kind of, individual stocks are volatile enough probably to gather interest around like trading them on chain as well. And that's kind of what crypto people want. So yeah, maybe you just kind of get there. And on the regulation side, I think it makes sense to do something like, you ideally, the way to make it work is that you're kind of like an issuer like Circle. So you have like KYB on your side to mint and redeem to kind of arbitrage the thing. And then you issue the token. It doesn't have voting dividend rights. And so you just speculate on it. And then you start getting that accepted into different places as collateral. So yeah, I think that's the kind of playbook. And there's also something to be said by, just for your point on the exchanges, how they work in the traditional system. They're worse than crypto exchanges. Like crypto exchanges, UX is crypto is a huge problem, but in this specific thing, it's actually so much better than the alternative, just in terms of like the response latency of what you see in the order book, like the fact that you can like Jupyter route and stuff like those are just so much better for this stuff than traditional exchanges are. So here you actually have a huge UX advantage over normal. And that's me the way I'd approach it.
That I agree with completely. Like from an exchange operator perspective, I look at a lot of these like traditional exchanges and I'm just thinking, what the fuck are these guys doing? Like they don't have market orders. Like what? Like what? You're not doing the one thing that makes you money? Like what? Like it's nonsensical. And again, like you don't have this tradition of market making. So like order book depth is non-existent. Like it's impossible to acquire like a reasonably sized position, or it takes a very, very long time. It is just nonsensical. But on the point of like there just will be demand. I don't have a strong stance on that. But I think the counter argument would be that crypto demand is very, very tailored towards like very explosive growth opportunities, and stocks just do not offer that. Like,
okay, that I agree with, but that I agree with right now. But I don't think that is going to be the way things are on the 5-10 year time frame. That gets into the anti-super cycle thing that I was mentioning. But
it does require a little bit of
there's some
positivity.
critical mass.
Yeah, but if you look at just like what's the annual vol on Facebook stock, like it's been pretty high. You know, like it goes up multiples and has gone down 80% and stuff like that just in the last 5 years. So it is non-trivial volatility. So like I get what you mean, and it has elements of correctness in it, but you know,
okay, I'm going to Google that as well, because if you see, yeah, I agree that companies like, I mean, Netflix at one point, like for weekend traded like a shit coin. But what tends to happen with those companies is that they do have very strong volatility around their earnings, not necessarily most of the time. What Teemu was saying is that crypto feeds on the all volatility all the time. So these are different cases.
Yeah, like, and you can argue that as crypto volatility generally goes down over time, then like everything kind of normalizes and people stop being insane, and you know, like we move away from like people are looking for 500x on meme coins to like, okay, like maybe maybe 5x is enough, and then stocks become somehow like a reasonable option. The other thing I wanted to mention, I've talked to a bunch of the projects that were doing this sort of 3 years ago, I guess you could say. It was like kind of like the first real generation of this type of stuff. People have tried to do this sort of thing for a long time, but they like actually had products out and so on. And I think one big issue is the business model. The stablecoin business model like doesn't exist for this. And while it's possible that you could replicate it, like you could just have like, here's Facebook stock without any of the dividends. And maybe you could argue there's so many stocks now that just don't pay dividends that you could kind of like do something. But let's say that the stock pays no dividends at all. Then how do you make money? If you make money on redemptions and withdrawals only, like that's a fraction. And the cost structure of running that enterprise when it's like a regulated market is just bound to be relatively high. And so I think you need something else. Maybe you could argue that you could take like a transfer fee on top of the network fee, especially on a network like Solana. I think that would be possible. I've actually said many times, I don't know if I've ever said it publicly, but I think stablecoins could take a transfer fee on really low priced networks. And that would actually be a very good business model for like a negative interest rate environment. So like the stablecoin business model sucks in a negative interest rate environment because like you're not getting any money on interest. And so there's a big discussion that has been going on for a while of like, okay, like what is the business model for that environment if it returns? And maybe it doesn't return for a long time and whatever. But the transfer fee, like if your actual transfer fee on the network is like thousands of a cent, like there is an argument to be made. You could charge hundreds of a cent, on transfer, and that might actually like at scale be quite a lot, which is sort of similar-ish to the business models around like wealth management companies. They usually take a fee on activity and like, stuff like that. But generally speaking, there is an issue there where it's just not as natural. People are not probably going to be that enthusiastic about giving up dividends if they exist. If they don't exist, then you have this issue of like, there's really nowhere where, money would be coming from. And there's one final thing, which I think is like an interesting nuance, which is that stocks tend to be numbered. And so stocks are actually like NFTs versus fungible tokens. And this applies to the share registry of the company. So you need to know which stocks individual people, and it's not like, it doesn't really make sense, but it's just how it's set up. And
Just a
getting around
question
this
there.
is also weird.
Does this actually happen on chain naturally then better? Because if you kind of mint the token, like take the USDC model, you can conceptually trade it at fractions.
As a fungible.
Yes. Yeah. Without, it's actually very simple. Yeah. The mechanics are simple. Like you can do that on chain. Yeah. That's very nice.
Yeah. It is nice. And it basically just like, but it does not convey. It sort of works if the ownership rights are actually held by the entity that's custodying or the operator, as opposed to the person who owns the token. And so there's obviously a lot of design space, but I think it's going to take quite a while to really figure out what it is. But I am sympathetic to the general idea that maybe it's like, it's kind of like Tether, where like at the outset with Tether, people were like, why the fuck would this make sense? But just the need for something of that nature that existed was high enough where like people didn't care if they were kind of like giving up their interest rights. And so maybe there's some area where the demand for that kind of collateral or whatever is high enough where they're basically willing to pay a premium for that asset. And that gives the operator a business model. And it's just a matter of figuring out like how that premium is charged.
Is this, or maybe Ricardo, is this like a reasonable question? But I know we've talked previously kind of in our chats about the incentive to hold stable coins in like LATAM and whatever, like different places. Is this kind of similar where, okay, like it's quite nice to hold, NASDAQ, S&P 500 or something like that Like,
Good question. I would need to look into what that looks like into Latin America right now. For instance, it wouldn't. I'm sure if Trade Republic, for example, is available in most of Latin America. And by the way, what you were saying, Temo, about the rental company holding the rights and whatnot, the ownership rights, at all lights, it does look like that is how Trade Republic would need to operate right now, because people can effectively do even fractional purchases of stocks. Say you can decide to put $15 every week on Berkshire Hathaway or something.
Is Trade Republic like eToro, where it's basically like a perps platform?
No, it's not perps. As far as I know, they're actually buying the shares. I just imagine that they warehouse the shares themselves. So if they have enough in the case of Berkshire Hathaway, they would probably just buy a share themselves and then just split internally ownership between whomever is buying whatever fractions. So, if this were to come out,
but that business model works because you're the exchange, right?
Sure.
Like eToro and this, I don't know, Trade Republic, but they make their money on the trading fees. If you're just the issuer, that you can't really apply that business model in the same way unless you build it into the actual token.
What I'm saying is that in most of Latin America, what I would look for first is, and I didn't know we were going to talk about this, so I didn't check. Of course, we're woefully unprepared. Is if something like Trade Republic is available there, if Nubank is giving this service already in some countries. I would imagine it's more appealing in countries that have a history of seizing people's foreign currency and then converting it forcefully to the local currency, like Argentina.
All of Latin America.
No, I actually know. For instance,
mainly
Costa Rica
Argentina, but yeah.
I mean, Costa Rica did not seize anybody's currency; they just massively devalued the local currency. And Argentina, they did seize foreign currency a couple of times, from what I know. I don't think Mexico has ever frozen dollar accounts. So, point is, if you live in a country where the country has never forcefully converted your currency, then you're probably not going to mind using a service that operates under local regulations like a Trade Republic. If you live in a place where that has happened, then chances are you care more about having something on chain like Argentina.
Yeah, and the other question relating to this is maybe like is the need in those places, is it financially that sophisticated? Like they save in dollars because they, their local currency gets devalued, but does that equate to like they would hold, S&P 500 ETFs?
You don't need to be that sophisticated to hold an ETF, man. And you have the younger generation that you have in Argentina and whatnot are survived devaluations based on Bitcoin. If you're willing to take your chances with Bitcoin volatility, you're definitely going to dollar cost average into an S&P ETF. That's not an issue of financial literacy.
Yeah, and there's an argument that crypto has made like a whole generation like incredibly more financially literate. And as that generation ages, they will look to diversify away from holding, huge amounts of XRP or whatever they're holding into other things. And so that makes sense. I just wonder if like the majority of the demand would just end up going traditional rails anyway. Maybe.
Like again, it would depend on if in recent memory the government has taken away your foreign currency and forcefully converted it.
No, I mean like even in the West or like in regular countries. I'm like it's more a question of like is like when if you're using, I don't know, Kraken or something, and you've never used the traditional financial sort of exchanges and stuff, and you want to diversify into more traditional assets, would you feel more comfortable doing it through Kraken or going to like a more traditional exchange? And that's actually not an obvious question. Like if you have dealt with those traditional things before, you probably feel more comfortable doing that. But if your only exposure to finance is Kraken, and Kraken has been, good to you, then maybe you just go through that. I don't know.
I do think it's a trivial question because there's a long history of studies of people just don't change the defaults and people follow inertia. if you're using Kraken and Kraken provides your stocks, you're probably just gonna stick there unless you have a very good reason to go through the whole process at E-Trade or what have you, right? People don't like busy work, man, and signing up for new shit is busy work.
A lot of people have signed up for Binance. That's very good.
Well, so I generally agree with that, but I think it depends on what the perception is. Like if Kraken, Binance, whatever are perceived to be like, just sort of as reliable financial institutions as any old ones, then sure. But if your perception is like, here's like the old financial institutions that deal with the old financial stuff, and here's like the Krakens and Binances that deal with crypto, you may just frame it like that in your mind, where you would, instead of trusting a Kraken with stuff on this side or trusting one of these on this side, you kind of keep them separate. But maybe the new generation.
I mean, yeah, I hear you, and that would be the sensible thing to do, right? Don't put your eggs on all your eggs in one institution. But I don't necessarily think that's how people think. I mean,
yeah, and honestly, like as Mika said, like they are better products, like they just are. Yeah. And if they bring these products to market, they would probably be more liquid than what you can get through your local broker, get better pricing, etc. Anyway, what else do you guys want to chat about?
What I actually thought we were going to chat about when Mika mentioned basically digitized stock was actually, which we don't need to go into, but what I would be very bullish on seeing more in crypto is fewer crypto companies issuing a useless token and more crypto companies of the type that don't actually have a protocol, they don't have a protocol business, they just happen to be running a business on-chain rails, then just issuing a tokenized security effectively, which you kind of hinted at on the chat as well, Mika. So anyway, that is something that I would definitely like to see more happening, but that's a longer discussion.
Yeah, and the lines I think get blurred a little bit here because of like regulatory stuff, but like issuing a useless token versus issuing a tokenized security, the difference doesn't have to be that large in practice. Like there are some businesses that do like a bit more traditional stuff, and yeah, it's not really baked into the contracts themselves, but they do like buyback and burn or something like that. From like even Binance, right, has done this. Yeah, and you don't get like the legal protections that you would necessarily need to do this kind of stuff on scale. But I think that's more of a matter of not wanting to go into that area versus like the unwillingness to do so. But if you take the kind of long-term view on this, it does seem quite clear in some sense that, okay, like more and more stuff goes on chain. So these crypto companies who are typically equity companies will also kind of do a token, and to varying degrees, you'll kind of improve the rights over time as you go on here, I suppose. And then eventually you would hope, like in the big win scenario, that, okay, like all companies do this kind of same thing. And it's not even that they're tokenized securities as such, or I mean, they are, but like that it's so commonplace to trade them on chain that there are just like versions of it on chain always issued by companies and, whatever. So like I mean, just pointing at the big picture is that these things should go on chain. Everything will go on chain. So it means that like these more equity like companies. So if you think like Helios, Alchemy, exchanges have already taken the first step here, but there's this whole class of other companies that kind of, I do think, end up on chain in a very big way over the next couple of years.
But so the kind of like the thing that we would be looking for in terms of analyzing progress on this would probably be something like a traditional exchange is starting to look at using, a public blockchain as a backend and that kind of stuff, or do you see it being sort of more crypto native, where like there's just like crypto companies that produce tokens that look like stocks or kind of like have the same?
There's two different things here, which is one is the kind of your life and how quickly you take your business on chain in a way, versus to kind of trading tokenized stocks. So I would say that maybe to change the discussion into something different, I'm actually talking about like companies really going, like crypto native companies going first, kind of fully on chain.
Yeah, that will be progress for me. Instead of, actual working businesses like Jupiter, Drift, Helios. Well, Helios has announced that they're going to launch a token, but it wouldn't surprise me. But instead of, the Jupiters and the Drifts launching a useless governance token, they actually sell tokenized shares. That would be progress for me.
Yeah, but even there, like Jito has a market on MetaDAO right now to basically distribute returns to token holders in some mechanism.
What has a market?
Jito's kind of new to distribute returns to token holders in some way. That has a MetaDAO market.
How have the MetaDAO like volumes progressed?
The volumes tend to be so that maybe your average or your kind of median market will see when there's like nothing really that interesting and it like kind of passes or fails clearly. That's where you get this kind of situation where it's maybe tens of thousands or something very small amount and that actually trades the market. And this one is an interesting market because I think the answer is quite clear from the Jito holders in terms of what they want, but the market impact is kind of bigger than before. So that's interesting to see on whether or not that itself drives volume here. So it's kind of a unique new position for MetaDAO. And then the kind of controversial markets where it's on the edge, those just tend to create a lot of volume. So kind of a bearish thesis in a way is that the volume scale very poorly with like the number and importance of markets because the outcomes are quite clear in many cases. And you only get trading volume when it's like at this kind of razor edge. And well, I don't know if that's like fully bearish. I maybe shouldn't say that, but that's just how the markets look like they're behaving. So I think this is like a pretty interesting look at if that really changes.
Yeah. Yeah, I think I generally agree. Like it would be cool to get stuff more on chain. I do think like it's not obvious how to actually do it. Like I think every crypto company would love to tokenize their stock. Not every, but like 90% of the crypto companies would love to tokenize their stock. It would just like it would make so much sense, but then the work required to actually do it is like quite large. And so I don't think unless like someone like Circle or Coinbase was like super motivated, like I don't see many of the companies actually having the resources to do it themselves. Even for like a startup or a new project, it's tricky. It's like an unclear business model, lot of work, lot of regulatory commitment, unclear outcome. So I think
what if you do the exchange thing, which is you issue a token, I guess it has some like platform rewards, and you do buyback and burn sort of in a sense in an informal way because it's not really written into the legal. And then you probably have like trust issue around that and you'll eventually run into problems. But what if it like it just kind of works like that?
I mean, I think you would need to have transfer fees in the token. Like, I don't think you can be like a exchange provider, like, because if you want the benefits, you need to have the token trading on Uniswap and whatever, like Jupiter's or wherever you are. And then you want to take a transfer fee as the issuer from the token. So like literally every transfer, there's an extra fee on it that goes to you. That could work. But then you just run into like the KYC things. Like again, you can maybe do what those companies have done in Switzerland, but at least for some reason, I haven't seen like a lot of companies doing that. And there are platforms for doing this in the EU and in Switzerland, haven't been super popular. And I think it might just be like a legal thing if like people aren't quite sure if it's like going to be okay. Because it is a difficult legal thing to figure out as well. It's like if I do this, is there like some jurisdiction in which this is not okay, you know? And so there's a lot of complexity, and I'm not sure. Like the useless governance token is kind of clean, right? Like especially if it's like a governance token with like a treasury that they're allocating. Like it's just sort of clean, and you don't really need to think about this stuff. It's always tricky when you need to start mixing in the traditional world. And like there was a couple of kind of like Uniswap with KYC dexes that were being worked on a couple years ago. There was like Violet protocol and something else. It seems like they haven't really gone anywhere. So it's kind of one of those things where like I'm not sure what would need to happen for it to like really start taking off. Because like you kind of need to bring the supply on chain first, and then hope to find the demand. And bringing the supply is a bit of a chicken and egg problem where it's not clear how to solve it.
Yeah, what if the incentive to bring it online is the same as it has been in crypto a lot, which is someone does it in the exchange model, which is they just do buyback and burn from whatever fees they have, even if they don't have a lot of fees, and the business gets super overvalued on chain.
Well, this is what I would assume might happen. This would be the driver for a lot of people doing it. But like when that will happen, unclear. Because again, there are companies with tokenized stock on chain. None of them have exploded. There are companies you wouldn't even heard of unless you've specifically looked on this thing. So, but I agree. Like that, like it probably needs to be something like, you know, a big, well-known influencer creator like Tokenized. You know, just like there's some other force that pushes people to just buy that token, and it happens to be available via this tokenized mechanism, and then that kind of normalizes it. But I think a lot of these projects are like, it's basically like a lot of these projects are like the project itself is like a platform for doing this, and they're tokenizing their own stock as like, you know, eating their own dog food kind of thing. And it's just not that, I don't think the stocks are that interesting. And it's also unclear how much it actually costs. So like this is, maybe I'll just make this point quickly. So I was discussing this like real estate token thing with a guy the other day. But one problem with all these types of things is that it's not clear like how much it actually costs to successfully tokenize something. And I would argue that the cost for tokenizing successfully is actually quite a lot higher than going the traditional route in many cases for sort of traditional stock. And the reason is that there's so much noise. And so you have to spend quite a lot of money on marketing. And that doesn't necessarily exist in the traditional sort of equivalent of this stuff. So like I think the hardest thing in crypto in general right now is just being noticed. Because if you're not noticed, if you're not kind of in that general sphere of things that people are interested in, you just kind of like drift off into obscurity, and it becomes very, very difficult to get out of there.
Well, we've brought up the Kobe quote before of the only scarce thing in crypto is attention, right?
Yeah, and so like if you're doing like if you want to like IPO in the traditional world, like let's say you're a relatively small cap, you want to IPO, you go to like whatever your local like, you know, pension funds and family offices and whatever. It's like a finite amount of meetings you need to take, and you need to convince some people to buy into your IPO. In crypto, it's like those guys are not going to come, and so you're like you have to get the crypto crowd. And then like how you find those people is like much less clear, because you need to identify from this like massive amount of people and noise, you need to identify individuals who specifically want to get the type of asset you're looking for, and finding those from within the massive sort of data set is, I think, actually quite hard, and requires you to pay potentially a premium, but like it just in general requires you to spend a lot on marketing. versus this other way is just like have some meetings, do some legal work. So there's that kind of thing as well. Like, again, this all depends on like where the proof point comes. So if you have a massive success story, which like justifies the expenditure, then people will do that. But I think people are maybe a little bit scared to be the first one because it may not work. And then you spend up millions on nothing.
Maybe to give a practical example of something in this area which has happened recently, which is Kaido.ai, which is like a pretty popular like analytics platform. They released a Genesis kind of NFT set, which is 1,500 NFTs, and that has a floor price of 6.4 ETH at the moment on OpenSea. And what exactly the benefit of this thing is a bit of a question mark. The trading fees do get kind of like distributed to top yappers, which is like their kind of leaderboard for people who are sharing content. So there's something there which kind of approaches this, but then is not exactly the thing yet. But it has high value. One should say like six times 1,500 ETH is like pretty good.
Yeah. But I think this is a conversation to be continued because I do think this is the way the world is going. I think it's just hard to predict how aggressively it does that. But I do need to go. We've kept this one short, guys. Congratulations to everyone.
The beauties of deadlines.
Yeah, I think this is among the first times we've done this. So thanks everyone for listening, and we'll see you next time.
That's